The flow is built around 7 realistic CRA risk areas, not a fabricated official audit list. CRA usually begins with matching or a document review. A review is not automatically a full audit. Its matching program compares returns with information received from employers and financial institutions, while an audit involves a closer examination of records. CRA review programs, CRA audit guidance. Flow. Open with the frightening CRA message arrow. Reassure viewers that honest errors can be corrected. Arrow missing or mismatched income slips. Arrow foreign income and foreign property reporting. Arrow rental and side income mistakes. Arrow number 4. The overlooked requirement to report a principal residence sale arrow. Pension income splitting mismatches, arrow medical. Disability and accessibility claims without documentation leads to inflated or questionable donations, leads to what to do when CRA contacts you, leads to simple protection. Checklist leads to calm closing. Imagine checking your CRA My account one morning and seeing a message that says, "Your tax return has been selected for review." Your stomach drops. You have paid taxes your entire working life. You have never tried to hide anything. And now the Canada Revenue Agency is asking for documents from 2 or 3 years ago. The frightening part is that the mistake may not be something dramatic. It could be one forgotten income slip, a small foreign pension, a basement rental, or the sale of the home you believed was completely tax-free. And number 4 on today's list surprises many Canadian homeowners because even when no tax is owing on the sale, the transaction may still have to be reported. Stay with me because I am going to explain 7 common warning signs in plain Canadian English, show you how innocent mistakes happen, and tell you what you can do before a simple review becomes a much more stressful problem. Before we begin, please subscribe and turn on notifications. This channel provides clear updates about Canadian pensions, OAS, CPP, GIS, taxes, retirement income, senior benefits, and the rules that can affect the money arriving in your bank account. These systems can feel complicated, especially when official letters use language that is difficult to understand. Our goal is to explain those rules calmly, honestly, and one step at a time so you can ask better questions and protect what you have worked so hard to build. First, let us clear up one important point. A red flag does not mean you have committed fraud, and it does not guarantee that you will be audited. The CRA has several kinds of checks. Sometimes a computer notices that a number on your return does not match a slip received from a bank, pension administrator, employer, or government department. Sometimes the CRA simply asks for receipts supporting a medical expense or another credit. That is usually called a review. A full audit is more detailed and can involve a closer examination of your records. Understanding that difference matters because receiving a review letter is not a reason to panic, ignore the letter, or immediately assume the worst. It is a reason to slow down, read carefully, and respond by the deadline. The first red flag is missing income or entering an amount that does not match the information slips already in the CRA's system. This is one of the easiest mistakes for a retiree to make because retirement income can arrive from several places. You may receive CPP or QPP, old age security, an employer pension, RRIF withdrawals, investment income, annuity payments, or part-time employment income. Each payer may issue a different slip. Common examples include a T4A, T4A, OAS, T4AP, T4RIF, T4RSP, T3, or T5. Consider a retired couple named Robert and Linda. Robert receives CPP OAS, a small workplace pension, and income from a RRIF. Linda receives OAS CPP and interest from 2 guaranteed investment certificates. They bring a folder of tax papers to their preparer in March. Everything appears complete, but one bank issues an amended T5 several weeks later. Robert and Linda do not notice it in their CRA account because they believe the return has already been handled. Months later, the CRA's matching program compares the tax return with the amended slip and finds a difference. That mismatch does not prove dishonesty. It may lead to a reassessment or a request for information, however, and repeated failures to report income can result in penalties. The safe habit is to make a list of every place from which you received money during the year. Compare that list with your slips, your bank statements, and the information available in CRA My Account. Do not assume that Autofill My Return is perfect or that every slip will appear at the same time. If a slip is missing or appears incorrect, contact the issuer. If you discover a missing slip after filing, you can generally request a change instead of waiting for the CRA to find it. Also remember that income can be taxable even when no tax was deducted before it reached you. Seniors sometimes believe that if a payer did not withhold tax, the payment must be tax-free. Those are two different questions. A pension, investment distribution, casual consulting payment, or other amount may still need to be reported even when you receive the full amount. The safest approach is to show every income document to your tax professional and allow that person to determine how it should be treated. The second red flag involves foreign income and foreign property. This area creates confusion for people who moved to Canada later in life, worked in another country, inherited overseas investments, or maintain an account in the country where they were born. A Canadian resident generally has to report worldwide income. That may include a foreign pension, interest from an overseas bank account, dividends from foreign shares, rental income from a property outside Canada, or a gain when foreign investments are sold. Reporting foreign income and filing Form T1135 are related, but they are not the same obligation. Form T1135 may be required when the total cost amount of specified foreign property exceeds 100,000 Canadian dollars at any time during the year. Cost amount is not always the property's current market value, and not every foreign asset belongs on that form. Personal use property can be treated differently, and registered Canadian accounts can have different rules. That is exactly why guessing is dangerous. Suppose Priya receives a modest pension from a former employer in India. She leaves the money in an Indian account to pay expenses when she visits family. Because the money never enters her Canadian bank account, she assumes it does not belong on her Canadian return. But bringing money into Canada is not what determines whether income must be reported. Her Canadian tax residency and the nature of the income are what matter. Another senior may own shares in a foreign company with a historical cost above the reporting threshold. Even if those shares produced very little income, a separate foreign property reporting obligation could still exist. On the other hand, a small foreign pension may need to be reported as income even when the person does not meet the T1135 property threshold. One rule does not cancel the other. If you have foreign assets, do not simply tell your preparer, "I have nothing overseas," because the income is small. Give the preparer the complete picture: the country, type of account or property, original purchase price where available, highest cost amount during the year, income earned, tax withheld abroad, and any sale or transfer. Currency conversion also matters. Keep statements and calculations showing which exchange rate was used. Foreign reporting can carry significant penalties, so this is an area where advice from a Canadian tax professional familiar with international matters can be worth the cost. CRA guidance says specified foreign property over the relevant cost threshold may require Form T1135, while foreign income must be reported under the applicable income rules. CRA Foreign Property Guidance. The third red flag is rental income, side income, or expenses that do not tell a consistent story. Retirement does not always mean a person stops earning money. You might rent a basement suite, lease a cottage for part of the summer, sell handmade products, do bookkeeping for a former employer, provide childcare, or receive payment for consulting. Income does not disappear for tax purposes merely because it was paid in cash, deposited by e-transfer, or described as a small favor. Rental income deserves special attention. The CRA generally expects the gross rent and eligible expenses to be reported using the proper rental statement. Reasonable expenses incurred to earn rental income may be deductible, but personal costs are not automatically business expenses. If you live in part of the home and rent another part, expenses may need to be divided. A repair that maintains the property may be treated differently from a major renovation that improves it for years. Replacing one broken tap is not necessarily treated the same as rebuilding an entire kitchen. Imagine George rents his basement for $1,100 a month. He reports some of the income, but deducts his full property tax bill, full home insurance premium, every utility payment, and the entire cost of a new roof. The numbers suggest that the tenant, not George, used the entire house. Even if George did not intend to make a false claim, the expenses may appear unreasonable when compared with the portion of the home that was actually rented. Keep leases, invoices, receipts, bank records, and a simple calculation showing how shared expenses were divided. If a family member pays only a contribution toward groceries or utilities, the arrangement may not be the same as a normal profit-seeking rental. So explain the facts accurately. Do not call a real rental arrangement cost sharing simply to avoid reporting income. Likewise, do not invent losses because someone promises that a rental property can erase all tax on your pension. CRA guidance distinguishes gross rental income, allowable expenses, and net rental income or loss. CRA Rental Income Guide. Now we come to number 4, the mistake many homeowners do not realize they are making: failing to report the sale of a principal residence. Many Canadian seniors know about the principal residence exemption. They hear that selling the family home is normally tax-free, so they reasonably conclude that the sale does not belong on the tax return. But exempt from tax does not mean exempt from reporting. If you sell or are considered to have sold a property that was your principal residence, the disposition generally must be reported on Schedule 3, and the appropriate principal residence designation must be made using Form T2091. This can apply even when the home was your principal residence for every year you owned it, and the entire gain is expected to be sheltered by the exemption. Picture Marie, a 74-year-old widow in Ontario. She sells the house where she and her husband lived for 32 years and moves into a smaller condo near her daughter. Her lawyer completes the sale, the mortgage is discharged, and Marie receives the remaining money. She tells her tax preparer, "I sold my home, but it was my principal residence, so there is nothing taxable." The preparer is rushed and does not ask another question. The sale is left off the return. The problem is not necessarily that Marie owes capital gains tax. The problem is that the sale and designation were not reported correctly. The CRA may receive information showing that ownership changed and then ask why the disposition is missing. Marie may still be able to correct the situation, but now she has deadlines, paperwork, and unnecessary worry. The risk becomes more complicated if the property was not always used only as Marie's home. Perhaps she rented the entire house for several years, changed part of it to an income-producing use, owned another property that the family also used, or moved out long before the sale. Only one property per family unit can generally be designated as a principal residence for a particular year. A cottage, second home, change in use, or period of rental activity can affect the calculation. This is why every property sale should be disclosed to the person preparing your return, even when you are certain it is tax-free. Provide the purchase date, sale date, proceeds, property address, selling expenses, history of use, and details of any other home owned during the same years. Do not rely only on the phrase principal residence. Allow the facts and the rules to determine the result. If you already sold a home and did not report it, do not ignore the issue. Review the return for the year of sale and get qualified advice about correcting it. The solution is usually easier when you act before several years pass. CRA guidance specifically says a principal residence sale must be reported on Schedule 3 and Form T2091, even though the exemption may eliminate all or part of the gain. CRA principal residence rules. The fifth red flag is an error in pension income splitting. Pension splitting can legally reduce a couple's combined tax in the right circumstances, but both returns must tell the same story. Eligible pension income can generally be allocated between spouses or common law partners through a joint election on Form T1032. The amount deducted by the transferring spouse must match the amount reported by the receiving spouse. The form must be completed for each year, and the related allocation of tax withheld must also be handled correctly. A common mistake happens when two returns are prepared at different times or by different people. One spouse deducts $12,000 as split pension income, but the other reports $10,000. Another couple reuses last year's percentage even though the pension amount changed. Someone else attempts to split income that is not eligible under the T1032 rules. You can generally allocate up to 50% of eligible pension income, but that does not mean every retirement payment qualifies. OAS cannot be split through this election. CPP and QPP benefits are not split on Form T1032 either, although CPP pension sharing is a separate program administered through Service Canada. Mixing up these two systems can produce an incorrect return. Before filing, place both spouses' returns side by side. Confirm that the elected amount, percentage, income deduction, income inclusion, and allocation of tax withheld match the completed T1032. Do not focus only on whether the couple receives a larger refund. Check whether the method used to create that refund is correct. CRA guidance requires a joint election with matching information and permits allocation of up to half of eligible pension income. CRA pension splitting rules. The sixth red flag is claiming large medical, disability, caregiver, or home accessibility amounts without the documents required to support them. Seniors often have significant health costs, and legitimate credits should absolutely be claimed. The danger is assuming every health-related purchase automatically qualifies or throwing away receipts once the return has been accepted. Medical expenses can include many products, services, treatments, travel costs, and care arrangements, but eligibility depends on specific conditions. Some items require a prescription or medical certification. Amounts reimbursed by insurance generally cannot simply be claimed again as though you paid the full cost yourself. A credit card statement showing a payment to a shop may not prove what was purchased, for whom it was purchased, or why it qualifies. Home renovations create similar confusion. A walk-in bathtub, wheelchair ramp, widened doorway, or other accessibility project may qualify under certain rules, but ordinary repairs or cosmetic improvements do not become eligible merely because a senior owns the home. Contracts, detailed invoices, proof of payment, and information about the person who required the renovation should be retained. The disability tax credit has its own eligibility process and generally requires certification on Form T2201. A person does not qualify solely because they have a diagnosis, take medication, or have reached a certain age. The decision depends on how the impairment affects the person under the legal tests. At the same time, an eligible senior should not be frightened away from applying. The answer is accurate medical information, not an exaggerated claim, and not giving up before checking the rules. Be especially careful with tax preparers who promise a huge refund before reviewing your records. You are responsible for the information on your return, even when someone else prepares it. Ask which line is being claimed, why you qualify, what documents are required, and whether the same expense has been claimed elsewhere. Keep detailed receipts and supporting records for at least 6 years because the CRA may request them after the return is assessed. CRA medical expense guidance, CRA home accessibility documentation. The seventh red flag is an unusually large charitable donation claim, a receipt that cannot be verified, or participation in a gifting arrangement that sounds too good to be true. Canadian seniors are generous. Many donate to hospitals, places of worship, community organizations, food banks, veterans groups, and disaster relief efforts. Unfortunately, dishonest promoters sometimes take advantage of that generosity. A legitimate donation claim requires an eligible gift to a registered charity or another qualified donee and proper supporting documentation. A simple thank you letter is not always an official tax receipt. Donating your time as a volunteer does not normally create a charitable tax credit for the value of your labor. And if someone promises a tax receipt worth far more than the money or property you actually gave, stop and get independent advice. For example, a promoter might say, "Give us $5,000 and we will issue a receipt for $20,000. The structure has been approved by the CRA." That sentence contains several warning signs. A tax shelter identification number does not mean the CRA has approved the tax benefits. A polished presentation, professional-looking documents, or a confident salesperson does not change the law. Check that the organization is registered, keep the official receipt, retain proof of payment, and make sure the amount on your return matches the eligible amount shown. If your donation is property rather than cash, valuation rules may apply. CRA specifically warns Canadians about arrangements promising a receipt greater than the real donation. CRA donation guidance. What should you do if the CRA contacts you? First, do not panic, but do not ignore the message. Read the request carefully and note the response deadline and reference number. Confirm exactly which tax year, line, claim, or transaction is being reviewed. Collect only the relevant records and organize them in a simple order. Include a short explanation when the documents do not tell the full story. Second, verify that the contact is genuine. Scammers often impersonate the CRA and pressure seniors to pay immediately. Click a refund link, disclose banking information, or buy gift cards. Do not trust caller identification by itself. End a suspicious call and verify the contact using official CRA information or the telephone number published on canada.ca. CRA Contact Verification Guidance. Third, keep copies of everything you submit and record the date it was sent. If you upload documents electronically, save the confirmation number. If you do not understand the request, contact the CRA through an official channel or ask an authorized representative to help. A calm, complete response is far better than sending a pile of unrelated papers or missing the deadline because you were afraid to open the letter. Here is a simple 30-minute protection check you can do. Write down every source of income you received. Compare the list with your slips and bank records. Ask whether you had foreign income or foreign property, rented any space, performed paid work, sold real estate, split pension income, claimed major medical or renovation expenses, or reported donations. For every yes, locate the documents that support the number on your return. Keep your tax returns, notices of assessment, slips, receipts, contracts, statements, calculations, and important correspondence together. Paper records can be stored in a labeled envelope or binder. Digital records can be scanned into folders labeled by tax year. The CRA generally advises taxpayers to keep tax documents for at least 6 years, and sometimes longer when an objection, appeal, late return, or long-term property record is involved. CRA Record Retention Guidance. Most importantly, do not become so frightened of a CRA review that you stop claiming benefits and credits you are legally entitled to receive. The lesson is not claim nothing. The lesson is claim the correct amount and keep the proof. Honest taxpayers can make mistakes. What protects you is checking your information, correcting errors promptly, keeping good records, and asking for qualified help when a rule is beyond your experience. If only one point stays with you today, remember number 4. Selling your principal residence may produce no taxable gain, but the sale still generally has to appear on your return with the correct designation. Share this video with another Canadian homeowner or retiree, because that one misunderstanding can create years of avoidable stress. Subscribe for more plain language updates about CRA rules, OAS, CPP, GIS, pension income, and the decisions that can protect your retirement. This information is general education, not personal tax advice, so when your facts involve foreign property, multiple homes, major renovations, rental activity, or older unreported transactions, speak with a qualified Canadian tax professional who can review your complete situation.